Good afternoon. My name is Stacy Chitty, and I'd like to thank you for taking part in today's Blue Vault Product Series webinar. Today, we will discuss economic recovery and institutional real estate with Bluerock. In fact, the title of our presentation today is Recovery Perspectives and the Evaluation of Institutional Real Estate for Investors Today and Tomorrow. We want you to know that the views expressed during the webinar are not necessarily the views of Blue Vault, are not guaranteed to be accurate, and should not be used to make investment decisions. First, a few little housekeeping items. I'll try to be quick about this. Some quick tips for our webinar platform today. This is new to us this year, so you may notice that some of the layout is different. Your view should include several windows. Each of the windows are represented by a button at the bottom of the screen. So basically, you can just click those windows based on what you want to see, and you can move the windows around however you would like to see them as well. So it's up to you. They could be rearranged and resized according to your preferences. The Q&A window is where you could submit questions at any time during the webinar. We will collect and address those questions at the end of the presentation portion of the webinar today, and that'll take us about 35 minutes to do that. So we have plenty of time for Q&A. We ask that at the end of the presentation that you click the green clipboard button at the bottom of the screen and complete the survey and provide us with your feedback. We would appreciate that very much. If you want to stay informed about future Blue Vault webinars, industry news, and more, make sure to sign up for our emails by going to our homepage and clicking the Get Updates button. Okay, well, before we start with the presentation, we'd like to go to a couple of polls just to get your feedback. You can see on your screen here, all you have to do is click on one of the answers. What best describes your outlook on investing now and looking into the future? Are you very positive, or are you mostly negative? What might that be? And I'm going to make an assumption that most of it is positive, somewhat positive and above, but that's the reason we asked the question. Okay, Laura? And as I thought, mostly positive. In fact, 21% of you are very positive. That's good to know. We'll have to look into the negative answers a little bit more. You could be right too. All right, Laura, let's go to the second poll. Which best describes which alternative investments that you use: REITs, BDCs, interval funds, or private offerings? Okay, Laura. Okay, very interesting. And I guess that makes sense because we are on a Bluerock webinar here. So thank you very much for participating in the polling. And it is my distinct honor today to introduce to you Ramin Kamfar. Ramin is the founder and CEO of Bluerock. Ramin has over 30 years of experience in various aspects of real estate, mergers and acquisitions, private equity investing, and investment banking. And Ramin is going to present to us today and lead us in this discussion. So, Ramin, I cannot thank you enough for participating with us today and sharing your thoughts, your perspectives with us. Thank you for doing that. And at this time, I'm going to turn the presentation over to you.
Thank you, Stacy, for hosting us, and thank you, everyone, for joining. I'm going to start with a little introduction. I've been doing this, as Stacy said, for over 30 years. I started my career in 1988 after I got my MBA at Lehman. That was after the Black Friday crash. So it was an interesting experience. The first, you're getting a lot of background noise, I guess. Thank you for muting yourselves. So I spent the first half of my career servicing individual investors. I started Bluerock in 2002 to serve individual investors because I saw a need there. So just at a glance, we've been around for 18 years, about $8.5 billion in assets, servicing 60,000 plus investors. Today, that's obviously grown over the course of our history. We are a top 3 sponsor of direct investment universe and number 1 among the independent broker-dealer channel, which has been our focus. You'll see us expand beyond that. And we've got a very highly experienced team. All the senior management have about 30 years experience. That gives us experience with a number of downturns, the great financial crisis. We're investing through that successfully, obviously. The tech crash of 2000, the real estate recession of the late 80s, early 90s. We've done north of $13 billion worth of deals, north of $50 million worth of real estate. I'm glad to hear that, to see the poll that most everybody was positive, because I want to start with some good news. And the good news is that the coronavirus spread is improving in the U.S. This is a county level chart. You can see the blue, and this is a July 1 chart. I'll show you a couple of others in a second. The blue is where cases are falling over a course of a 7-day period. Gray is about the same. Yellow, orange, and red are slightly rising, and significantly rising. You can see a lot of red, orange, and yellow on this slide. This is 3 weeks later, 7/21. You can see that it's moved around a bit. You see a lot more blue on this chart, which is good. And then 3 weeks later, which is yesterday, you see a lot more blue on this one, a lot more blue and gray, a lot less dark red, some orange, some yellow still. So it is improving. It is a matter of, and the important part of that is that we've done this without lockdowns. So we've been able to get the virus tamped down across the United States. Obviously, it's uneven, and it's going to continue to be that way until we have a solution in terms of a vaccine. But social distancing and masks and so on and so forth do work in order to be able to keep the virus under control, but keep the economy up and running. And I think that's positive news as we go through the rest of this COVID crisis. The other good news is that we do have a solution on the way. There are north of 160 vaccines in development. There are a significant number, as you see on this page, that are going into phase 3 trials. And their number, actually, there are 2 key ones. One is Moderna, which is 4th on this list, and one is the Pfizer vaccine, which are going to report results in November. This chart obviously shows the vaccines that are in later stage trials, phase 1, 2, and 3, being orange, yellow, and blue, and then the approval under emergency use is green. The bad news about the COVID spread was we had a lot more than we wanted in the U.S. The good outcome of that was that it allows these tests to get significant, to achieve statistically significant results earlier. So the Moderna and Pfizer were supposed to report end of November. Now we're hearing news that they're going to report mid-November. And then after that, we expect that the FDA is going to approve them under emergency use for frontline workers, high-risk people, and then generally for the general use population sometime in the new year. So there is a solution on the way. In the meantime, there are a number of therapeutics that are coming. We have 2, remdesivir and dexamethasone, both of which have shown to help patients recover faster and not get as severe a disease. So we are making progress, and this is lightning speed compared to prior vaccines, the fastest one being 4 years. So we should be on the other side of this. Sometime next year, I think we've got, at least in terms of the health crisis, the government is doing the right thing in terms of the stimulus. They have acted much faster than they did in the GFC and with much more force. Just to put it in perspective, the total U.S. federal budget is $4.4 trillion, and in the GFC, you had about $1.5 billion of stimulus, and it took about 24 months to get that out. And in fact, the first piece of it didn't get out until we were a year into the crisis. Here, within a month, the government was able to get out $2.7 billion, and now we're working on the next phase of the stimulus. The Republicans have offered up $1 trillion. The Democrats have asked for $3.5 trillion, and we think that it's going to be somewhere around $1.5 to $2 trillion. So, and it's the right thing to do, and that's not a political statement. It's because we've put the lockdown, effectively put the patient on life support. We shut down everything, but you need to, to recover from the health crisis, to stop the spread of the vaccine, kind of like putting a patient in a coma. But when you put a patient in a coma, sometimes you put them on life support to make sure that the blood's flowing. And in this case, the lifeblood of the economy is financial markets, make sure that people have money to spend. So we think the government's doing the right thing. And as a result of that, when you talk about recovery perspectives, people ask us how the recovery is progressing, and the answer is yes. It really and by that I mean it's variable. It depends on what part of the economy are you in. These are recovery high frequency indicators. And the months, the bars that you see are April, May, June, and July, dark blue, medium blue, light blue, and gray, sorted by industries. As you go to the right, you see that essential services and services that are low touch in terms of low contact have done well and have recovered, or significantly recovered from where they were. And by that, I'm looking at housing and utilities, communication, whether it's Netflix or otherwise, financial, education, et cetera, et cetera. You look in the middle and you see hospitals and physicians' offices and motor vehicles opening back up, and the bars are increasing. And then you go to the left-hand side, and that's a different story. You've got industries that are much more impacted by this crisis, and it's going to take them, and the damage there is going to be much larger, and potentially some of it's going to be permanent. That's transportation, clubs, sports and entertainment, hotels, student housing, gambling, et cetera, restaurants, and so on and so forth. So that's one snapshot of the recovery. The other snapshot is over time, and this is one of my favorite charts. You look at it and you're like, well, this is, what does this tell me? That it's so confusing, and that's the point. We had all of this activity, and it starts with, if you see the right-hand side, and we're happy to, if you have questions or you'd like copies, let us know. It starts with mortgage applications. Then rail traffic, new business applications, hotel occupancy, business openings, rental bookings, petroleum demand, job postings, TSA checkpoints, and so on and so forth. Everything basically went down to zero or close to zero. And now you've had a variable recovery with a lot of moving up and down. Mortgage applications are 120% of where they were in February, but TSA checkpoints and hotel occupancy is significantly lower, and they've bounced around. And that is really what this recovery is going to look like. What we have is two different crises. One is the health crisis that we're getting through, and then in the aftermath of that, there's going to be an economic recession that will be very mild or non-existent for some industries, and it will be it'll be problematic for others. So what we expect, and all of the pace of it will depend on what I showed up front, which is how the virus is going to spread locally and whether localities have to tighten up or loosen restrictions, et cetera, et cetera. So we're going to have, it's not a V-shaped recovery, it's a Nike swoosh, but the up leg on the Nike swoosh is going to have jagged edges. There's going to be a lot of W's there, and that creates some risk in terms of investments. The other piece, I want to go back to the slide which showed stimulus, and we've added the bar on the right-hand side because that doesn't get talked about as much. Everyone's so focused on what the next round of stimulus is going to be and whether we're giving people $400 a week or $600 a week. One thing that gets missed is that on top of that fiscal support, there's monetary support. The Fed has pumped in $8 trillion of liquidity into the market between financials and going out to the market and buying stuff, businesses, households, and government. And that's almost twice the size of the U.S. federal budget. It's almost twice the size of the stimulus that we have. And that's going to have an impact on the market. Again, it's the Fed's job to make sure the market stopped functioning in late March, early April. Fed's done a good job of starting them up again, providing liquidity. But that doesn't come for free. It comes at certain costs. And this is what the money supply looks like. So you can see that, this goes back to the 60s, money supply growth. It's been faster. It's the fastest on record. Okay, you look at QE1, back in the GFC, the Fed said quantitative easing 1, 2, 3, 4, all the way over across the last 10 years. It's never been this fast. Now we've gone past QE4 and we're in helicopter money and you're growing very fast and you're back at levels that in the 1970s created inflation. And that's not by mistake. That is something that the Fed's been talking about, and I think in the next couple of months when they have their next meeting, you'll see that they'll come out with an inflation target, because the way to get out of this, all of this extra debt that we've created to support the economy is to devalue it by increasing inflation. And that's going to be in the playbook of the Fed, and that's going to have an impact for where we should invest, obviously. So that's something to look at. Actually, Morgan Stanley has a pretty good report called the 3 Ts, tech, titans, and trade. And what they're arguing is that given the political situation, that the government's going to go, we're going to have trade's obviously become an issue. Tech is becoming an issue with antitrust movements, especially if we have new change in the government. They hold the heads of all the big tech firms in front of Congress. So change is coming at tech, trade, and titans, which means that all these billionaires that are under attack, and they're going to get taxed higher. And all of that on top of the fiscal support, on top of the monetary support, is going to be inflationary. Yeah, and it's a call that they've made. It's the first time they've made that call over the last 30 years where they've had a disinflationary call. So it's a pretty good report. Again, if you want it, ask us for it. We're happy to share it. Trade by itself, all of this onshoring that's going to happen because the supply chains have broken down and our trade with China has broken down, that's going to be inflationary because it's going to cost us more to produce stuff. It's going to bring potentially good jobs back to the U.S., and that's great, but at somewhat extra costs in terms of inflation. So so what are the unintended consequences of what's happening here? Well, one of them is that the money has to go somewhere. And if you look at where how the Fed's balance sheet started to grow, which is the blue line, and how the market reacted, which is the orange line, you can see the S&P's reaction is pretty close to what's happening in terms of the Fed's money printing. That money has to go somewhere. And I've got a page here that talks about it. Well, does it all go into the stock market? No, it's gone into financial assets. And that's the Fed's game book. And if you look at all the financial assets, you see it in depressed rates. These are average rates over the last 10, 15 years for each of these categories. And today is the light gray color, and the average is the dark gray color. T-bills have gone from 59 bips to 14 bips. I got my bank statement yesterday. My interest for the month was a penny. So there's no interest that gets paid on short-term deposits anymore. T-bonds have gone from 2.25 to 68 basis points. I'm going to skip stocks for a second. Investment-grade bonds have gone from 2.6% down to 1.4%. That's less than, so AAA corporate credit, these are AAA bonds, AAA corporate credit is borrowing at rates that are less than the U.S. government was borrowing just a few months, 2 months ago. Not 2 months ago. Yeah, 2 months ago, in the midst of 6 months ago, before this crisis. Google just did a bond offering, and I think they paid something like 50 basis points or 65 basis points inside what the U.S. government is paying. And look at high yield bonds. High yield bonds, on average, have yielded 6.2%. In crises, that number is normally 13%. Today, they're at 3.88. Last week, there was a company that did a high yield financing at 2.75, the lowest that it's ever been. Now, this is called high yield. It's not called high spread. Okay, the reason they in crises and GFC and the ones before that, they go to 13% is because default rates go up, which they've ticked up. The default rate today is expected to be about 7%. You're not going to get paid. You don't get paid for that at 3.88. So where has the money moved to? The money has moved into stocks. You can see that's where people are looking for a yield without the risk of going into high yield, which is now low yield today at 3.88. And has it been all stocks? No, it's very bifurcated, the market. You have 6 stocks, which is Facebook, Apple, Alphabet, Amazon, Netflix, and Microsoft, that have benefited from there because that's where all the growth has been. If you look back to the beginning of the year, those stocks are up 45%. The rest of the S&P without it is down 4%. You don't see it in the headline numbers, but it's very, very concentrated, and that creates potential risk in terms of, now, we like stocks. We're believers in stocks. We think that stocks are should be part of any investor's fully diversified portfolio. We also believe in the right bonds, et cetera, et cetera. But we are also, we look for relative value. Where can I find relative value? Let's talk about stocks for, going back 5 years. Again, the same, you see the same issue, which is the phantom stocks, the six stocks I just mentioned, is where the growth has been since the beginning of 2015, 240% versus 20% for the rest of the S&P. Again, not visible in the headline numbers. Go drill down a little bit deeper, and you can see that's where the earning growth is. The earning growth on the phantom stocks has been 85% over those since 2015. That's partially what's driving the stock price appreciation. Part of it is multiple expansion. What about the rest of the S&P? The rest of the S&P has had 10% earnings growth, and that's after the 2017 tax cuts. Without the tax cuts, that number is the S&P 500, leaving aside these top tech stocks, is in an earnings recession. And that can't go on forever. That creates risk in the market. And, so that's something that we should be aware of. On top of which, you've got policy risks that are increasing. We're in an election year. That's always, it creates potential policy risk. And if you look at Biden's tax plan, and this is not a political statement, this is my focus is just on the investment side. It is not, I'm not making any comments on politics today, but the plan, which is vigorously supported by the Democrats, and the progressives say it's not enough, is to increase corporate tax rates back to where they were and before the 2017 tax cut. That's to 28%. Add a 15% minimum tax on companies' book income. That's, Amazon has tremendous profits that they show on their financial statements, but doesn't pay any taxes. So the argument is they should pay a 15% tax on that. Double the minimum tax on foreign subsidiary profits from 10.5% to 21%. Those will impact. Goldman and others have looked at it in terms of the impact on S&P, and the impact is at least 10%, potentially larger for the tech stocks. And if you go back and you take 10% off of this S&P, you can see where the earnings are going to be. They're going to be below where they were in 2015. On top of which, the stated plan is to increase capital gains rate to ordinary income rates for people who are wealthy, above $1 million in income. So if your capital gains rate is going from 20 or 25 to 39.6, are you going to hold on to your capital gains, or are you going to sell your stocks? Are you going to advise your clients to sell their stocks before that goes into effect? that's an issue on top of which, the program is to tax unrealized gains at death. So potential policy risk here, another potential policy risk is, that shouldn't say political risk, it should say policy risk, is that corporate buybacks are now evil. Corporations should share the wealth as opposed to buy back their stock. What that discussion misses is the fact that corporate buybacks have been 90% of net demand for stocks over the last 10 years. Foreign sector has been very light. Households have been negative. Pension funds, insurance companies, other domestics have been negative. And buybacks are, one of the big things that is, driving the stock market. And you can see it. If you listen to stock commentators, they talk about earnings season. People go into a blackout. Companies go into a blackout. They can't buy back their stocks. That puts downward pressure on it. So we have significant policy risk going forward. It's just something to be aware of as we build a portfolio. So where does real estate fit in all this? We look for a relative value. What is the relative value of real estate today? Moody's put out a good COVID-19 heat map, which talks about high exposure industries. You can see global shipping, retail, passenger airlines, lodging, leisure, tourism, cruise lines, gambling, and so on and so forth. Those are the industries that are going to have, a longer recession and have a harder time recovering. And then you've got some moderate exposure industries and then low exposure industries, and real estate is one of them. Just because it's an essential, and it is generally tends to be low human interaction. Not all real estate, obviously. Hotels are going to have major issues. I'll talk about the sectors in a bit. Retail is having significant issues, but the other core, there are core sectors, industrial, for example, multifamily, that are the data centers or the life science that are beneficiaries here. How is real estate done over prior periods, including this is 5, 10, and 20-year returns, so a number of recessions in here. You can see this is a risk-return quadrant. The x-axis shows you lower risk on the left, higher risk on the right, and then lower return on the bottom on the y-axis and higher return on top. So where you want to be is you want to be on the top left quadrant. That's where you have your higher return and lower risk. Traditionally, we've, in finance at Wharton, we were taught that, you get low risk, low return, and that's where the bonds are. That's the bottom left quadrant. Or you can have high risk, high return, which is where publicly traded REITs or stocks are. You can't be in this, it's impossible to go in this sandbox where you get high return and low risk, low volatility. But that's not true. Institutionals have had access to this asset class. Retail hasn't until the last several years. And it delivers tremendous risk-return characteristics, similar returns to publicly traded securities, but with the risk level, with the volatility level of bonds. So the best of both worlds to a certain extent. Now, how's it done in recessions? Over the last 42 years, there have been only 4 down years, 10%, and that is a tremendous batting average. batting 900, and those 2 recessions have been both real estate focused and banking crises. So when you look at it on the next page, this is comparing real estate, which is the blue. You see the highlighted green areas. This is quarterly numbers versus the S&P and the REITs. You can see and this is a drawdown chart, shows you how much the drawdown has been on institutional real estate versus the other asset classes. You see the other asset classes have a lot more and a lot larger drawdowns. And the drawdowns, we've gone through many cycles over the last 40 years, obviously, but real estate has only gone down when it's been the epicenter of the crisis, like in the GFC, where it was overbuilding of housing and over leverage of condos and everything else, oversupply, again, overbuilding and over leverage. And that's not the case here. And that's why real estate is going to be impacted by secondary impacts of COVID. For example, as I said, hotels and retail, but the rest of the real estate will do well in this downturn. That's our point of view. On top of which, when you look at cap rate spreads versus 10-year treasuries over the last 20 years, the average spread is 275 basis points. Today, that number is over 400 basis points. What does that mean? That means that someone buying real estate today at a 400 basis point and financing it with today's treasury rates gets into a low double-digit income return at a, with relatively easily. And that's the secret to real estate's performance, which is institutional real estate delivers 2/3 of its return in income. So when if you're buying something at a 5 cap rate, and you multifamily, and you're borrowing it at a significant, from Fannie or Freddie at a significant discount to that, you can get a 10%-ish return just on the income side. The appreciation on top of it is obviously a benefit. So there have been, if you look at it, if you standardize it and say, okay, the long-term average cap rate, cap rate spread has been around 275 basis points. And where are we, and how does this compare historically? That's what you see here. The blue line is the long-term average. We've marked with dotted lines the one standard deviation up 1 and down 1, and we're in a +1 standard deviation event. And that's happened twice in recent history, in 2003 and 2010. And in 2003, the 3 and 5 year returns on were for institutional real estate were 15%-ish, and in 2010, it's the 3 and 5 year forward returns were 13%-ish. So traditionally, this is a very good time to buy real estate in terms of relative value and in terms of future performance. And not to mention, it delivers low volatility, and that is something that is important in terms of building an efficient portfolio. We added some, we put this is a drawdown and volatility chart here. So you can see it's the same as my prior chart in terms of the x-axis, lower risk to higher risk on the x-axis, 0% volatility on the left, 40% volatility on the right, and drawdowns. What's your max drawdown? 0 on top and minus 40% on down. We put 4 of the main low volatility indexes on here, and to show what to show how they perform. And then so that's the Morgan Stanley World Minimum Volatility Index, the Vanguard Global Minimum Volatility Index, Morgan Stanley. This looks like it's doubled. One of them is a U.S. minimum volatility index and the S&P low volatility. And they didn't perform well. They delivered high volatility and low returns, which is not what you want. Let's compare that to institutional real estate. Low volatility, still a little drawdown. Obviously, returns were negative at the peak down, but with very low volatility, and that's how you build an efficient portfolio. You put this into the rest of your portfolio and delivers portfolio efficiency. We've shown the chart that we had earlier in terms of yields. Excuse me. On T-bills, T-bond stocks, investment grade bonds, AAA bonds, and high yield bonds, which is BB bonds, the highest grade of the high yield bonds. And we've added institutional real estate, NPI. You can see the yield doesn't come down that much. It's relatively stable. Why? Because of generally it's fully leased, low leverage, long-term leases in place. And that's what the benefit of real estate is. That's how it delivers the income return, which delivers stability in turn. Excuse me for a second. And so in terms of efficient portfolios, we figured we'd show you the actual numbers. The bottom is a 60-40, the bottom is stocks and bonds portfolio, the blue bar. 50-50 stocks, bonds on the left, moving across to 60-40, 70-30, and 80-20. Now, it's about a 6-ish annual return. This is over the last 20 years. You can see the standard deviation is at the bottom. The annual return is on the left. what happens when you add institutional real estate? Well, we've added 20% institutional real estate here. So we start with 50, 30, 20 and move over to the left to 80, 20 in terms of institutional real estate. And you can see that your portfolio has moved up in terms of return at the same level of risk by about 10 to 11%. It's gone from 6 to somewhere about 675. That is a huge increase because in the institutional world, because it compounds on an annual basis. That 1% will make a big difference over time, especially if you're delivering it with low volatility. And that's why we think real estate is well suited for portfolio build outs. It's a strong anchor that delivers attractive returns throughout the cycle, low volatility, diversification, and it's a key part of having a fully diversified portfolio. Obviously, institutions have been doing this for since the late 70s when they were able to run these simulations. The computers got and the data sets got robust enough to run these and realize how you really build an efficient frontier here. Now, not all real estate is created equal. There are winners and losers. We've seen an acceleration of trends. What does that mean? We've taken the Moody's format in terms of heat map and created our real estate heat map. You can see the red is the high exposure. That's what you want to avoid. Lodging, hotels, gaming, strip centers, BC malls. We think student housing, senior housing, skilled nursing has significant risk in it. You've got the moderate exposure stuff and then the low exposure beneficiary, which is multifamily, industrial, medical office, data centers, towers, life science, and so on and so forth. That's where you want to be. The sectors we're already diverging. Industrial has had great tailwinds. So has, and retail has had great headwinds, and this is just accelerating those trends. What we like and what we're invested in is what you see on the left, which is positive, less sensitive, positive impact. Industrial, apartments, data centers, and self-storage, along with life science. And we have no exposure to hotels, very little to. We have no B and C malls, some retail that's grocery anchored, and so on and so forth. So the type of real estate matters, but in general, real estate is a great addition. We think that it's relative value today, and it's a great addition to the portfolio. On that note, I'm going to stop talking and hand it back over to Stacy.
Thank you, Ramin. We appreciate that very much. Quite fascinating. All the data from those charts and graphs tell a story. We appreciate you pulling it all together for us. There's several questions. Let me start with just some more general questions at first. What is your general outlook for the rest of this year, but also into 2021, given the job loss in the economy, and how does this impact your investment point of view?
That's a very good question. Obviously, it's going to be, I think the recovery is going to be squiggly, as I said, Stacy. You really have, and the reason this is difficult is that you really have two crises on top of each other. You've got a healthcare crisis, which is COVID, and then you've got a recession that's going to get layered on, that's getting layered on underneath it. We had the COVID crisis led to lockdowns. We had 40 million job losses. Most of that was temporary. As we've opened up Disneyland and so on and so forth, the hotels are opening up, casinos will open up, et cetera, et cetera. Most of those people, restaurants have opened up, most of those people will go back and get their jobs back. But there is underlying all that, and COVID will go away over time with a vaccine, and hopefully we'll have better treatments going into this season and we'll be more prepared for it. So won't need another major lockdown like that. But underneath all that, if you drill down into the data, which is what we look at, there are sort of permanent job losses. Movie theaters, right? Cruise ships, airlines are going to be able to lay off people October 1st. So it'll be interesting to see what they do. And that's a normal recession, and you're going to have to you're going to have to pick and choose what that's going to happen. And part of, until we have the vaccine, and it's not just having the vaccine that works, the phase 3 results, it's got to get approved by FDA. And normal approval by the FDA, we're going to get emergency approval. A normal approval is 6 months because that's your safety period. Firstly, it has to show it's effective. Once it's effective, then you need 6 months to see if there are any side effects, especially in the more vulnerable groups like older people and so on and so forth. So it's getting vaccinated that's important, and there's a timeline to get there. So we'll get through that, but we're going to be choppy until we get through this, and we get the, and we have the, and we just, then we're just left with a normal recession. And so you have to look for a relative value. Does high yield make sense at, would I buy the high yield issue last week at 275? I think those prices are, no, I wouldn't. So you just have to look and see where the value.
Do you see, Ramin, do you see some industries just disappearing as a result of this? Or do you think all industries eventually come back?
I think we're going to have significant change in terms of at the industry level. There are some industries that will be changed permanently. Movie theaters, for example. I think everyone probably saw Disney just announced that they've been, all of these big movie theaters have these $200 million blockbusters. They're sitting on them, and it's costing them time value of money. Theaters aren't opening. They can't open them. Disney finally broke ranks and said, we're showing Mulan on Netflix, on Disney Plus for $30. So, and they negotiated to shorten the exhibition window where the movie theater has to get it, and you can't stream it from 90 days to 14 days. The economics of that industry just changed permanently. I think cruise lines are going to take a long time to come back. International travel is going to take a long time to come back. Offices are, until we get a vaccine, offices there's going to be significant extra costs. So that you have a transition. Retail, for example, will be permanently changed. Now, that's not a new trend. It's just you're accelerating that trend from what was taking the next 5 years into this year. And so you're going to have record number of bankruptcies, et cetera, et cetera, et cetera.
Yeah, it's quite intriguing and humbling to think about all of the changes that could happen. Second question, Ramin, what is the future? You've talked a lot about institutional real estate. What is the future for institutional private real estate in individual investor portfolios?
Well, I think individual generally follow institutions in terms of their investing philosophies, because you've got the leading institutions that do the research, like Harvard and Yale and Princeton. That education then flows through to the rest of the institutions, and over time. And that's taken, institutions started investing in real estate in the late 70s, early 80s. So it's been a number of decades, because it takes a long time to allocate. And I think we're at the stage where individuals are getting educated and reallocating, because it used to be that they would get access through their defined benefit pension plan at the corporate. Well, the corporates have gone away. Corporate plans have gone away. State and local still has it. That'll be an issue on its own. But now you don't get access to that, and you're giving people 401ks, or they have IRAs, and saying, okay, you're in charge of your own retirement, but they don't have the product. So there's a definite need. There's education. Even the wirehouses have now acknowledged that in terms of the alts. And the people who are on this call are at the forefront of that education and delivering what individuals need. Everyone on this call is going to look back 10 years from now and say, and look at what they did in terms of this historic shift into alternatives. It's not just real estate, but real estate's obviously one of the biggest alternative asset classes.
Okay, let's turn to a few of our audience questions right now, Ramin. Probably one of the questions that is on everyone's mind. Kelly wants to know, have you seen rental abatements ramp up in the portfolio? Have you seen occupancy rates drop in the portfolio? She is trying to drill down to cash flow effects on the portfolio. Can you address that?
Well, it really depends on the asset class. Obviously, hotels, as I said, are having major issue. Mall, particularly B and C malls, have major issues. We're mostly in multifamily, and on the multifamily and industrial. On the multifamily side, we actually have a big portfolio through our REIT, and rental abatements are, rental payment plans are about 1%. So, and then we have a bad debt expense of about 200 basis points. Bad debt's normally 50 basis points, and that's gone up to about 200 basis points. But that is, when we looked at it, and our REIT just reported recently, when we drill down on that, we've got maybe 15,000 tenants, and there's maybe 400 of them that are sitting there and saying, listen, I have income coming in. I'm getting, I have a job, or I've got unemployment coming in at the state level and the federal level. Yeah, I'm making more money than I was, but I'm not going to pay you, and you can't evict me, right? That's an eviction moratorium. So no good deed goes unpunished. We try to help everybody, but there are some people who are going to say, you have some of that in the portfolio. So we'll get through that. The occupancy's actually gone up on the multifamily side, particularly when you look at our footprint, which is outside of the big six. I think that offices really haven't been impacted. We just moved to a big, beautiful office in Manhattan. I'll encourage you to come and visit, which we're not using now. And we looked at it and we said, can we not pay rent? No, we have to pay rent. We have an obligation to pay rent for the next 7 years. So industrial, obviously, industrial is obviously doing very well. And all of this onshoring back to the United States is going to increase the demand for industrial here. So, and then not only that, but also people have realized that the just-in-time supply chain is too fragile. We need to keep more inventories for everybody, for manufacturing, for healthcare, in terms of, drug supply, et cetera, et cetera. So that's going to be a big boost to industrial. And then we're big investors in which we're very big in, but that's our biggest exposure, I think. And then life science. We just wrote a big check for life science. All of this shows the importance of our healthcare system and our life science. And I think no matter who's in office post-election, that's going to be an area of focus and investment. So that's where you want to be.
Okay, another quick question. Greg wants to know how you are addressing all of the empty buildings. And I think you've addressed some of that, but obviously somewhere in the country there are empty buildings, or there are going to be empty buildings. What do you do about that?
Well, that's an issue, right? So when you look at our portfolio, it really has to do with, you have to start with market selection, right? Where I can tell you that we don't have, it's really two questions. What do we do with our empty buildings at Bluerock, and what do you do with empty buildings in general? Let me answer both of them. I would say at Bluerock, we don't have any empty buildings, because if you have the right markets, you need to look at, we're long-term trend investment. Okay, we want to see what the long-term trends are. The long-term underlying trend here, I think I read Warren Buffett's a biography a while ago, autobiography, and it's called Snowball. And they asked him, why is it called Snowball? He said, well, the secret to successful investing is find a long hill and throw a snowball off the top, right? Work with a trend. So we're long-term trend investors, and the long-term trend is we've been moving from an industrial economy to a technology economy, to a knowledge economy. That's the trend you want to follow, and you follow it in terms of picking the right markets, picking the right submarkets, picking the right assets to invest in. That's why retail, for example, has an issue, and it's a paired trade with industrial, right? Industrial is the beneficiary of all the losses in retail. You want to be in industrial long term. You don't want to be in retail, and that's the way we've played it. Now they're saying some of these malls are, and that so you want to be in the right place. You want to have to look. You want to look forward and say where's the puck going to be in 10 years and invest there. So we've done well with that. I think in terms of in general, what are you going to do with empty buildings? You're going to have some malls in particular that are going to be empty. There's talk about converting them into industrial spaces or residential or mixed use. And that all has to do with the market. If it's a vibrant market, adaptive reuse is obviously something that's been done forever. If it's a market that's losing population and losing jobs, like the Midwest, for example, has a number of those markets, or downtown Detroit, for example, then there's not going to be a better use in terms of adaptive use. So you need to pick your market.
I guess people are going to need to live somewhere. That affects
Absolutely. I didn't talk about multifamily, obviously, because the beauty of the United States, one of our secret strengths, and I have a chart on this, but I was getting in too many charts, so I didn't put it up, is that the U.S. has the highest population growth of any developed country across the world. If you look at Asia, Far East Asia, that Japan has been losing population for a long time. Same with Korea is losing population. China's getting to a stage where it's losing population. Europe is losing population. Why? Because the death rate is higher than the birth rate. The U.S. population is growing by 1%. And that is a tremendous strength here. That's 3.5 million people a year. And over time, they need a place to live. And the trend has been towards multifamily living from buying houses. Why? Because it all has to do with this move to a knowledge economy. In the industrial economy, you moved where the job is. In my parents' generation, you graduated college, moved to Rochester or Armonk to work for IBM or Kodak, had a 30-year career, got married, bought a house, raised 2.5 kids, white picket fence, and you moved to Florida. And why did you stay 30 years in that job? Because that's what the job market was, and you had a pension that tied you. Now in the knowledge economy, kids graduate, they move where they want to live, whether it's Nashville or Denver or Austin, and the jobs are following, companies are following them to attract the talent, and the job is 5 years. Why? Because you don't have a pension and you can move from place to place. Well, if that's how you're going to live, you want the flexibility, you're not buying a house. Okay, that's just tying you down, on top of which they just learned that in 2008 that it doesn't guarantee you're going to make money in the house, right? So the big trend, again, the big tailwind is towards multifamily living. So I didn't talk about those as empty buildings because the population is growing every year and there's going to be demand. Where you're going to have empty building in terms of housing is a big mansion that are built in the suburbs of some of these markets that are losing population. I wouldn't want to own those, but multifamily will do. If anything, it's underbuilt, particularly since nothing's getting built right now. So you're going to come out the other side of the economic recession, and all of a sudden you're going to be in a situation you were in 2010 when you didn't have enough multifamily and rents are jumping up.
Okay, let's try to get a couple more questions in here. Michael wants to know, was Bluerock able to maintain distributions during the 08-09 mortgage crisis?
Absolutely. We maintained our distribution, we covered our distribution, and there was never ever any consideration of cutting our distribution.
Okay.
And it's the same situation for this for what we call the GCC versus the GFC, the Great Corona Crisis.
Right. Okay. Mike wants to know, he wants you to cover real estate ownership in general and how it will be impacted by businesses being behind in their rent payments. You've addressed a lot of that. I guess I will add to that and say the government's got programs to help people, no eviction, loans, grants, that sort of thing. How long can we go before the government cannot help us anymore?
Well, that's a very good question. So I think the government support so far has been right, because you shut down you're shutting down the economy. You're throwing 40 million people out of jobs because you're forcing the businesses to shut down. You got to put money in their pocket so that they can pay the rent and put food on the table. So, how long is it going to last? We're going to get another stimulus bill, right? We're going into the election. I don't think either party. Trump signed some executive agreements. Maybe they work, maybe they don't, but that's not the right solution. I think the right solution is for the two parties to come together, and they're going to do that and pass another stimulus bill, and they will. I'm not sure it'll be before August, but it'll be, if not, it'll be in September, and that's going to take us through the year. I can't tell you if it's 400 or 600. And then you potentially have a new administration coming in. So it's going to depend on what that administration is going to do. I was just reading that part of the VP pick on the challenger side, part of the platform is $2,000 a month to everyone. So it's going to go for, I think it's going to go for a while. And, in the absence, but we don't really need it. We get to a stage where we don't need it. In our properties, for example, if you have class, real estate divides into Class A, top institutional stuff, Class B, and then Class C. If you're in the Class C stuff, that's where the damage has been with all the service workers and restaurants and so on and so forth that have closed and they can't make their rent and they need that support. And it's horrendous that that's where the impact has been, but they need help paying their rent. They're dependent on that if they've been thrown out of a job. But when you get to the Class A stuff, the renter base is such that the income ratio is low. They have savings. They're the higher income renter. Whether it's office or residential, et cetera, and so you don't really need it. How long is it going to? And so that's a question as to whether it's needed. As to whether it's going to continue, I was just the Bank of Japan owns 43% of all of Japanese government bonds. So how long can it continue? It can continue for a very long time. Is that the right answer? I hope we're not going.
On a side note, real quickly, how do we pay $29 trillion in debt back? You sound like you might have the answer to that. If the answer is growth, so
right.
far that doesn't seem to work. How does that and how does the growth catch up with the tremendous amount of spending? And does that not come back to haunt us at some point, sooner rather than later?
Well, Stacy, that's a very good question, and you gave the answer: is to grow. Right there are two ways to grow. Right, one is real growth, GDP growth. Right, as I said, we're in a good place because what is GDP growth? GDP growth is population growth plus productivity growth. Right, so we're starting in a good place. We're at plus 1% annually on population growth. So if we can get 2% productivity growth, that puts us at 3% versus places in Europe or Japan where they're minus 1%. That's why they're having a hard time growing GDP because they got to get 1% GDP growth just to get flat. The second way to grow is to grow not on a real basis, but on a, but on a nominal basis. And by that, I mean inflation. Right. So if the Fed can generate inflation, right. So you're getting, and they're not mutually exclusive. You can have both. If the Fed can generate inflation, which is why Powell's talking about inflation targeting, okay, saying we need to be at 2% or above. So if you get 1% population growth, 2%, 2% productivity growth, you're at 3%, and then another 2% inflation or 3% inflation, the debt is fixed, right? So the 29 trillion also. GDP is GDP on a nominal basis, right? So if you inflate your GDP to twice as much, you're all of a sudden you have half the debt. Now the problem with that is, if inflation goes up, then interest rates will go up, and so you're going to put the economy into a tank. But that's, again, if you listen to what the Fed is saying, they're talking about targeting rates. So they're gonna try and push up inflation with all of this money printing, and on top of which, you've got this bigger term trends like trade coming on board, right? We had disinflation because we had low inflation because all of a sudden the labor pool of 2 billion people opened up across the U.S., across the world, and that puts pressure on wages, which is creating a lot of issues today. A lot of that is going away when it comes back to the U.S. So you've got all of these long-term trends. They're going to print the money, push inflation, and on top of which they're targeting interest rates. So the Fed's going to buy across the yield spectrum, up to 10 years, maybe up to 10 years, to keep rates low while they generate inflation. That's how you solve it. Otherwise you've got, and it's, and that's the solution.
Well, I'm glad that someone smarter than me is trying to figure all that out. Sounds like a monumental task, but we're going to hope for the best. Ramin, there are just a slew of additional questions. We're just not going to be able to get to them all. I will say to the audience that this webinar will be available for replay. And also, you can get the slides. That's been asked a few times already. You can get the slides. We will make those available to you. And, of course, if you need to get in touch with Ramin or Bluerock in general, you can do that. Their website is bluerock.com. And Josh Hoffman also can be contacted directly. Josh is the president of Bluerock Value Exchange. And he says you could call him at 208-475-2380. If you have any question for Josh or Ramin, please reach out to them. And Ramin, that's going to do it. And I just can't tell you enough how much we appreciate you sharing with our audience today. We're going to have you back. Maybe just to touch on that one issue about inflation. That sounds like something that needs to be addressed, not only for us, but for financial advisors' clients into the future. So thank you very much. And thank you, audience, for joining us today. We look forward to seeing you again. I think our next webinar is next Tuesday, and we hope you'll join us then. Ramin, thank you. Will you come back?
Stacy, thank you for hosting me, and absolutely would love to come back anytime you'll have us.
Sounds great. Well, thank you for joining us today, and everyone have a great day.
Thank you, everyone, for joining us.